大家好，欢迎回到大脑透镜，我们致力于过滤垃圾信息，挖掘优质内容。今天是2025年5月23日，有朋友很期待我们更新大摩亚洲团队22号的一个会议的要点啊。大家遇到的问题还是和以前一样，晚上墙内搬运的视频翻译的问题比较多，直接听英文呢，对部分的朋友还有挑战，而且会议的时间太长。这个会议的含金量很高啊，很好的梳理了近期全球以及亚洲经济金融领域最重要的事情和对未来经济金融的展望。我们呼吁大家善待自己的大脑，避免被各种碎片化的信息充斥，一天到晚感觉非常的充实，实际上杂乱无章。开玩笑说像一头蒙圈的泰迪犬。这次的内容比较多啊，有5张的幻灯片，毕竟是一个半年的总结和展望，但是我们也不想过于的精简，有部分的网友可能觉得还是太长，那么可以调一下视频的速度，或者直接点击评论区的时间跳到自己感兴趣的部分。我们幻灯片的最后一张是精华中的精华，可以截屏带走。好，我们进入第一部分，全球经济展望，关于美国和中国。关税假设，大摩预计美国对中国进口关税将征收 30%，而对全球其他地区征收 10%。232条款相关产品关税将长期存在，虽然关税低于最初的预期，但仍然比较高，将影响全球的贸易和资本支出，对全球经济产生负面影响。对全球经济增长的预测从去年第4季度的 3.5% 下降到2025年的 2.5%， 这是一个大幅度下调啊。对美国经济增长的预测下调至 1.5%。 关于美联储的政策，预计2025年不会降息，2026年降息175个基点。欧洲的部分，正面的因素是欧洲央行可能在年底将利率调到 1.5%， 而德国将实施扩张性的财政政策，然后是较低的油价。目前的油价的确对买家来说是比较舒适的水平啊。负面的因素，关税的不确定性以及全球贸易的放缓，还有欧元的升值，这是比较确定的。欧元区的增长预计下调到 1%。 其他的因素，法国进行的财政改革以及意大利和西班牙面临的挑战。说到财政改革，大脑透镜补充一个信息啊，法国目前的财政赤字率是 6.1%， 如果不采取措施，明年可能接近 7%， 而公共债务占 GDP 的比例达到 112%， 到2027年可能到 120%。 作为对比啊，美国现在是 126% 的水平，日本呢是一枝独秀，占比 230% 到 240%。 中国公开的数据是占 90%， 但是地方的隐形债务规模呢，我们一般人不知道，所以不做评论。亚洲经济、利率和汇率的展望。宏观方面，中美关税战虽然暂缓，短期缓解了贸易中断和增长的疲软，但是全球增长放缓将影响以贸易为导向的亚洲，不确定性导致出口增长和资本支出减缓，中美贸易没有快速的解决方案，不太乐观。外汇方面，美元继续走弱，支持亚洲货币继续升值，那么泰铢、新币、台币表现比较好，人民币相对平稳，印尼盾和菲律宾比索可能落后。利率方面，预计亚洲央行将降息，印度利率最具有吸引力，因为印度央行的流动性支持，如果美联储降息，将进一步支持亚洲收益率走低。下面是亚洲股票市场分析，这里不包含中国，中国有另外一个板块专门分析。股权展望，短期谨慎而长期乐观。大脑透镜提醒个人投资者，这里是行话，我翻译一下，就是未来几个月谨慎一点，长期来看非常乐观，但是我们要边走边看，后面再更新。实际上就是最近你要小心一点。盈利和估值，2026年盈利预测低于大家一致认为的7到9个百分点。那么新兴市场是 9%， 日本 7%， 因为日元可能继续升值，支持逢低买入的策略。那么逢低买入对个人投资者是一个挑战啊，所以大脑透镜提醒大家谨慎。超配的市场有印度、新加坡、阿联酋和巴西，而低配的是台湾和韩国。日本因为出口盈利的担忧，需要减少超配，但是受企业改革和通胀的支持，对个人投资者有难度，谨慎一点。行业推荐是超配金融行业，这里特指新加坡、巴西、印度和阿联酋。超配人工智能的受益者 那基本上是人工智能这个供应链上的一些供应商了，低配半导体和硬件。下面是中国经济的展望和对应的股票策略增长的预测。2025年 GDP 的增长可能在 4.5 到 4.2 之间，而2026年调到 4.5 至 3.6 之间，趋势是逐年下滑。关税方面，对中国加权平均关税维持在 40%， 而芬太尼相关的关税可能部分取消，新行业的关税可能增加。这里新行业应该主要指汽车、半导体、制药相关的行业。政策的应对，预计第四季度推出 0.5 到1万亿的财政刺激，这是蔡志鹏博士对前面1到 1.5 万亿财政刺激的下调。货币政策方面，预计下半年有政策利率的下调，准备金率的下调。未来1到2年，中国将从债务驱动转向技术驱动增长，这一点非常重要。这里隐含的意思，中国不大可能推出大的刺激政策或者大规模的放水，似乎都不大可能。那么转向技术驱动呢？这里可能对有一些人有利，有些群体就不利了。基本上不会写代码，也不会硬件设计，而且也不是这个行业链条上的人可能会吃点苦头了。类似于美国和华尔街硅谷都不沾边的行业，那么除了公务员可能就有压力了。汇率方面，美元对人民币预计年底达到 7.15， 这个还是有一点涨幅啊。股票策略 Laura 整体乐观，偏好港股 AI 相关的板块有结构性的机会。熟悉大佬透镜的朋友可能知道，如果投行提到结构性的机会，对个人投资者都是一个挑战啊，就是你需要深度的研究相关的板块和个股才能找到一些机会。而对宏观敏感行业如消费必需品、重工业、房地产、材料特别小心，我想这个大家现在都有共识了，都不会去碰。日本方面，国债预计到2026年收益率下降，日本央行可能到2026年底保持利率不变，长期国债因供需失衡而面临陡化压力。这里大佬透镜稍微解释一下什么是陡化压力。是这样的，由于日本长期国债就是10年期以上的市场供给过剩而需求不足，特别是缺乏稳定的国内机构的买家，但是海外投资者要求更高的收益率作为补偿，这样导致长期的国债收益率上升，使得收益率曲线变得更加陡峭，这就是所谓的陡化。跟昨天美国财政部拍卖20年国债收益率大幅度上升是道理是一样的。外汇方面，美元对日元预计到2026年第二季度会达到126，也就是日元要升值，因为美国增长放缓和政治的不确定性会削弱美元的避险地位。那么日元、欧元、瑞士法郎将作为替代避险货币表现优异，这个我们以前的视频都有聊过啊。日元和瑞士法郎是外汇市场常用的避险货币。第三个是金融稳定风险，日元的长期国债收益率上升，债券价格大跌而触发机构强制卖单。那么如果短期收益率因抛售快速的上升，日本央行可能进行干预以稳定经济。不确定性，美日的关税谈判如果90天内谈妥了，日本央行可能加息。目前就各方的消息来看，90天内谈妥的可能性不是太高啊。下面就是我前面提到的精华中的精华总结啊。经济方面，关税虽然暂缓，但是全球贸易仍然会下滑，资本支出也会下滑，从而对经济造成非常不利的影响。利率方面，预计美国年内没有加息，而日本央行不动，亚洲其他国家会降息。外汇方面，预计美元会贬值，亚洲货币升值，欧元升值。股票高配印度、新加坡、阿联酋和巴西，低配韩国、台湾。潜在的风险，关税的不确定性，美债和日债收益率的上升，美国经济衰退，中国继续扩张供给侧，这样会造成产能继续过剩。债市方面，美债收益率上升。那这2天债市最大的事件可以说没有之一啊，就是美债收益率的上升。就昨天美国财政部拍卖20年国债这个收益率上升的问题，这可以说是全球金融行业最大的事件啊。好，今天我们就聊到这里，接下来是英文原声的完整版。如果我们的幻灯片对您有用，请帮忙订阅、点赞、转发，我们会持续改进。
Good morning and good afternoon, everyone. It is May 22nd, Thursday. Welcome to Morgan Stanley Asia Macro Webcast. My name is Crystal G, Asian EM Equity Strategist. Before we start, please note that this event is for Morgan Stanley institutional clients and financial advisors only. It is not for member of the press. If you are a member of the press, please log off and reach out separately. Please also note that this webcast and questions may be recorded. Today, we have a big lineup of speakers. So firstly, we have Chi Wong Lee, Principal Global Economist, Daniel Blake, Asia EM Market Strategist and Head of APSJ Quant Research, Derek Kam, Asia Economist, Laura Wang, Chief China Equity Strategist, Cai Zhipeng, China Economist, Koichi Sugisaki, Head of Japan Macro Strategy, Gatun Ku, Asia Macro Strategist. During this webcast, you can send the questions at any time from the Ask a Question text box. So we have just published our mid-year outlook report yesterday for both economists and strategy. So let me invite Chi-Wong Lee here to cover the global perspectives and including growth and policy rate expectations. Over to you, Chi-Wong.
Thank you very much, Crystal. So let me start with our basic assumption on how we think about the tariff policy, because it's of course important in thinking about the global economy going forward. We are expecting Chinese tariffs to be around 30%, and the rest of the world to be 10%. And also on Section 232 related product-related tariffs are going to be long-lasting. Of course, there is a huge uncertainty, so if anything changes, we will have to adjust our forecast going forward. So given that, we can see the tariffs are back to the reality, meaning that it's not as high, which was not really making economic sense. The point is that the tariffs still remain very elevated, which will mean that the negative impacts on the global economy in terms of both global trade as well as the capital expenditure going forward. And in addition to that, the uncertainty, as Bernanke noted in the 1980s, the uncertainty always delays not always, but many of the cases delays the capital expenditure. And of course, there's a problem of how the sensitivity is going to look like, but there will be a negative impact, of course. So we are expecting global growth to go down from 3.5% in 2024 Q4 basis to 2.5%, so 1% down for the global economy. But the notable point is that we are expecting U.S. to slow even more, which is around 1.5%, mainly because U.S. is having, number one, tariffs, number two, the immigration problem, which is not very often discussed, but we think it's very important. And number three, the fiscal situation, which is just going to be mostly the extension of the tax cuts before, so which is not going to add in terms of the growth rate. And because of that, the Fed is going to be in a very, very difficult position, because we are going to be having the slow growth, but at the same time, because of the tariffs, the inflation is going to accelerate for a while. So because the Fed is quite data independent, it will be very difficult for the Fed to do the hike for a while, a cut for a while. And then once unless the employment situation gets really, really worse, but because of the immigration issue, it is very difficult to see an unemployment rate going up too high. So given that, we are not expecting any cuts from the Fed within 2025. But once the cut starts in 2026, they will have to do 175 basis point cut, which is, in other words, below neutral rate at this moment. That's for the Fed. And also let me point out several points about Europe. Europe is facing three positives and three negatives. Three positives include ECB has been easing, and that easing cycle is going to continue until 1.5%, which is below neutral by the end of this year. And the fiscal situation, especially Germany, is quite expansionary. Number three, lower oil prices is actually positives, but at the same time, negatives are coming from number one, tariffs, number two, global trade slowdown, and number three, the stronger euro. So because of all those negative parts, it's very difficult for us to imagine that the euro area will exceed more the 1% growth. So a slightly below potential growth rate is going to what we are having. But of course, if you take a look at the country by country, it will look quite different, where Germany is going to be expanding quite a lot, so the growth rate is fine. France is going to be having a fiscal consolidation a bit in a successful way, which is not the case for Italy. And Spain is still strong, but the super bonus positiveness is actually raining down. And back to you, Crystal. Thank you.
Thank you so much, Chi-Wong-san. And then trade policies are crucial for Asia, and uncertainty weighs on growth and capex. So now let me invite Derek here to dig into how the team see Asia growth and central banks policies going forward.
Thank you very much, Crystal. I would highlight sort of my comments on around what has changed and what has not changed. I think it was about just a bit over a month since we had to sort of revise our growth numbers for Asia. So in the context of the last 5 to 6 weeks, what has changed? Number one is that the tariffs on China has definitely come down much earlier than we expected. Previously, we were expecting tariffs on China imports to go to about the 30+% level by the fourth quarter of this year. And obviously, we've reached that level faster than was initially expected. The second thing that has transpired over the recent weeks is that there has been a weaker US dollar environment and stronger Asian currencies environment. And we do think that these two sort of factors will A, sort of take out the worst of the disruption to trade flows, and also B, provide a partial offset to the growth momentum softness that we were expecting previously. But then on the second part of what has not changed, I think one, as Chi-Wong was pointing out earlier on, the uncertainty on the global trade front and also uncertainty as it relates to the global trade policy still remains. We still have tariffs that will be likely to be 10% on the rest of the world, which will still depress sort of global trade activity, which will have the spillover implication to Asia. The second thing, as what Chi-Wong was also mentioning, is that we still have the backdrop whereby global growth is going to be weaker over the course of the year, and Asia being one of the more externally oriented regions will definitely suffer the spillover effects from that weaker global growth backdrop. In terms of how we're thinking about the growth outlook, I'll just highlight 3 key points. The main key message is that, we are getting a reprieve from the uncertainty, but we're not necessarily getting a relief at this point in time. There are 3 reasons why we sort of think that these still will continue to weigh on growth. Number one is that we're already starting to see uncertainty weighing on the business cycle, and there's already been 1 round of damage that has been done. Trade flows have been disrupted, and now there's front loading that's going to be underway. And we do think that as the front loading effects start to fade, when we face with a weaker demand environment, the Asian exports growth will sort of lose the momentum on that front. And that will also have a spillover implication on the capex cycle, which we think will be the principal area in which the growth downside will be sort of materializing from there. The second thing is that as it relates to the US-China trade relationship, yes, talks are continuing, but we are cautioning that there is no quick fix, because at the outset, if you want to fix the trade balance, it actually reflects the fundamentals of 2 very, very different growth models. One in the US where there's consumption which is too high, and in China's case where the investment is too high. And unless we get a fundamental fix in the growth model, the issue is unlikely to be resolved sustainably. The third thing is also that as we think about the trade deals and also the potential for sectoral tariffs, that is still going to lend an area of uncertainty in the outlook, as we're still not quite sure what will happen as a result of the trade deals that will be probably signed in the coming weeks and months. So how does it sort of relate to the overall sort of inflation and monetary policy backdrop? On the inflation front, I would note that, Asia already at the starting point does not have an inflation problem. We are already sort of back towards target or even below target for a lot of the central banks' comfort zones in terms of inflation. And then if you add on the point that tariffs is going to sort of weigh on exports and aggregate demand, we now have a weaker oil price environment, and also we have a weaker US dollar environment that is going to be sort of adding further disinflationary pressures, which will therefore keep it entrenched for a lot of the Asian economies. And so with that backdrop, as you have weaker growth and you have sort of inflation below and within comfort zones, we do think that there will be much more monetary easing going ahead. Just yesterday, we saw that Bank of Indonesia has actually resumed its rate cut cycle because of the currency. And so therefore, we do think that, a lot of the central banks will feel much more confident about actually cutting interest rates to support growth in the months ahead. And so we are expecting significant easing across almost all of the Asian central banks over the next 6 to 9 months. Finally, in terms of the risk, I think that clearly, given that we're expecting growth to decelerate by about 90 basis points, which would be similar to what happened in 2018 to 19, the difference that can make, the key factor that can actually make a difference, would be if you can actually get a very quick US-China trade deal that can actually lift the cloud of uncertainty and hopefully sort of arrest the decline in the capex cycle and overall growth momentum. That's it from the Asia economic side of things. Crystal, back to you.
Thank you, Derek. And then now let me invite Zhipeng here for the team's view on China, not just on trade policies, but also their feedback on the domestic structural issues and stimulus.
Thank you, Crystal. So we raised China's GDP forecast with the assumption of a lower tariff path, but also a smaller and more delayed additional fiscal stimulus. So in terms of actual numbers, 2025 growth is raised to 4.5% due to this tariff data. Now 4Q over 4Q growth now stabilizes at 4.0%, up from 3.7% that we expected earlier. And for the full year of 2026, growth will also be quite resilient at 4.2%. Of course, the biggest change will be on tariff assumption, given this unexpected de-escalation. Right now, we assume that this 40% overall weighted average tariff rates on China from the US, to be sustained throughout the year, instead of a previous assumption, which is a gradual decline from around 100% in the second quarter to 45% in the fourth quarter. The rationale for this tariff assumption is that, of course, number one, the earlier prohibitive tariff rates causes dislocation and is unsustainable, but 40% could be managed with pain, of course. And number two is that if these fentanyl-related tariffs can be partially rolled back due to further negotiations, the U.S. might, impose additional sectoral tariffs due to all these ongoing investigations. So we think this 40% is probably going to be the mean throughout the year. And then with this differential tariff path, we think this means a 0.6 percentage point smaller growth drag on 2025 real GDP growth. But of course, this tariff rate is still high. It will still slow growth in the second half, particularly with the payback of exports front loading. I think there are a lot of news going on saying, the shipping activity between US and China is rebounded very quickly. But I think we think that these inventory, adjustment or preemptive buildup of inventory basically cannot grow to the sky. There's a limit. And our US team actually expects the first quarter of this year will be the high mark of inventory investment. So there will be payback in the second half way on growth. So, and that leads us to our policy assumption. As growth continues to slow down, we expect Beijing to unleash a 0.5 to 1 trillion additional fiscal stimulus in the fourth quarter of this year. That is more lighter and more delayed than our previous forecast when we assume 1 to 1.5 trillion to be announced in the third quarter. But we continue to expect monetary easing to be modest, assuming 15 to 20 bips policy rate cut, and also 50 bips, triple R cut for the second half. So these are our overall, tariff and the policy assumptions as well as growth forecast. They are largely in line with the latest consensus. But of course, one thing that we're slightly out of consensus is on the RMB exchange rate. We now expect USDCNY to reach 7.15 by the year end. That is up from 750 from our previous forecast. The key reason is our global FX team's cautious view on the dollar. They expect the DXY to fall by 9% by the mid of 2026 due to this basically convergence of growth between US and other economies, as well as rising concerns over the safe haven status of the dollar. And then given this dollar trajectory, we are assuming the RMB to slightly appreciate against the dollar. There are two key reasons. Number one, basically Beijing wants to maintain or present an image of being stable amidst this uncertainty caused by US policy. Number two, in terms of trade relation, I think with the USD weakening against a lot of major currencies, I think basically Beijing would not want RMB to depreciate too much against the dollar, because that will mean the RMB will weaken a lot with other neutral currencies, and that could raise concerns over basically an import surge from China. So that's our slightly out of consensus view on RMB. But despite all these changes that I mentioned, what has not changed is our overall narrative on China. That is, tariffs is still a major demand shock that could complicate China's deflationary challenges. Policy will remain quite reactive. It will not aim to basically engineer a very fast reflation in the economy, but it's mainly about providing a floor to growth. And in the next 1 to 2 years, China will continue to basically undergo this very difficult economic transition from debt-fueled growth in the past towards one that is more centered around tech innovation. Finally, on the risks, I think the risk arises from two parts. Number one is on the tariffs. Of course, if this tariff negotiation does not go well, tariffs could go up after this 90-day truce. And then, of course, on the other hand, if trade negotiations goes well, and these fentanyl-related tariffs can be partially or wholly rolled back, leading to even lower tariff rate. So that's on tariff rate. There's also two-side risk on policy. On the upside, policy will become more consumption-centric, which in our view will have a higher multiplier impact on China as the economy is operating below its potential level. But on the downside for policy is that given this external shock, Beijing doubles down on a supply-centric policy mix because they feel that they are more certain on the multiplier impact from investment. So given these two-way risk on tariffs and on domestic policy, on the upside, we think China's GDP growth can reach 4.7% and 4.5% this year and the next. And on the downside, 4.2% for this year and 3.6% for next year. Yeah, I'll stop here.
Thank you, Zhipeng. So now we have laid out the concepts of the context of how we see growth expectation globally. And also we think that it's key to share our views on how to position the market. So now let me invite Daniel here to share the regional market allocations and where we recommend investors to position. Over to you, Daniel.
Okay, thank you very much, Crystal, and for the speakers. So conclusion up front for us on Asia and emerging market equities. We laid this out. I'm just going to share my the outlook here. For us, we do think the outlook is cautious in the near term, but there are a number of factors that are actually looking more constructive in the medium term. So if we look at the outlook here for our targets, you can see 3 to 6% upside on a 12-month view across major regional indices. That's despite our earnings being 7 to 9% below consensus. So what are the near-term risks? We've heard from our colleagues here. First is an earnings rebase alongside that inventory and supply chain digestion into a weaker macro environment in the second half. Second is we still are waiting for those Section 232 tariffs to come. We've still got difficult negotiations over autos and parts, and we think that semis and pharma tariffs are likely to come in behind that. And so we do think this focus of the tariff and trade agenda is going to drill into a number of sectors that are pretty large weights within the Asia universe. And then finally, we've got a patient Fed not cutting until March 2026, compared with market pricing of 2 cuts by the end of the year, and this supply digestion in the long bond market, both in Japan and the US, just as another factor. So these near-term risks mean we would recommend staying cautious. We'll get into the recommendations of where we sit right now. But the longer-term opportunities, lower US dollar, particularly into next year, lower rates, both on the central bank pricing, but also the long end of the curve, we think going into next year again. And then finally, bottom-up macro and market reform themes in major countries, including Japan, China, India, Korea, Singapore, UAE, Saudi Arabia. So when investors are thinking about their ex-US investments, we think the bottom-up prospects are actually looking better than they have in some years. So cautious near term, optimistic longer term. Just quickly on the tariff rebound, again, pricing in not just the reprieve that Derek outlined, but also probably a full relief. If you look at the light blue bars here, 2025 year-to-date returns, basically with that recovery from April 9th to now, we've seen the market actually move to high levels, with topics up mid-single digits, Europe up almost mid-teens, China up almost mid-teens. So we do think that they're priced in a full relief on tariffs, and there is still some overhang that should be factored in, as we do think we've got a higher level, not just on China, where the expectations were for higher China tariffs, but we still have these legacy tariffs, particularly given the Section 232 on autos, steel, aluminium, really weighing on the Japan, Korea, and Germany outlook. So for tariffs, this is not yet resolved, and again, I think the market has probably priced in too much relief relative to the impact here, and this is probably a function of companies themselves not having visibility in the first quarter results numbers to show this, and also the pull forward of exports has probably presented a stronger outlook going into the impact of tariffs here. In terms of the other near-term factors we're watching, we recently published our signposts for a trough. We updated them in the report published yesterday on the right-hand side, you can see here, we've actually lowered the score from 37 to 34 out of 60. The higher the score, the more likely we have a durable trough in markets. So this lower score is because we've taken away, I think, some of that technical support. Also, valuations are much less supportive of the market, putting in a sustainable trough right here. So cautious in the short term, but then where do we recommend positioning more broadly? I'll go to our targets and the outlook on the 12-month view. Okay, so if we look at the outlook here, first starting with this near-term concern on earnings, we're 9% below consensus on earnings by 2026 for emerging markets. We're 7% below for Japan, which is really a function of that dollar yen being forecast to go all the way to 124 dollar yen by the end of 2026. So earnings is the key concern, but valuations, we're assuming when we start to get into those broader Fed cuts, broader Asian policy, central bank easing cycles, and a lower dollar, that we can actually sustain above average valuation levels for EM. We've marked that at 12.5 times, and Japan at a pretty conservative 13.8 times. So we do think valuations will help to offset some of the impact here, and we'll be looking to buy dips as we start to get this rebase in earnings put through. So in terms of positioning then, here and now, not just on the 12-month view, we have kept India as our most preferred market. For us, we are seeing this market offering the strong domestic capital market buying through systematic investment plans. It's a market where we're actually slightly above consensus on earnings. We're looking for around 15% CAGR for the next 2 years. We've got policy easing that's coming through. So we do think the backdrop for an ongoing earnings outperformance cycle is in place for India. We've kept Singapore and UAE as overweights within the overall framework. We do think they're multipolar world beneficiaries of capital market development and talent migration and wealth migration. We've reduced slightly the overweight on Japan equities. We position within Japan on the beneficiaries of corporate reform and reflation, but we're concerned around the export earnings outlook, and we've moved to an overweight stance on Brazil. Brazil as a market that's been very cheap but challenged by both global financial conditions and also domestic policy mix. And we think this easing of global financial conditions with a weaker dollar and a peak in the central bank policy cycle is going to be important. And then more into 2026, we've got elections in late 26, so we think the market will start to consider pricing in the risk of a better policy mix in terms of less fiscal deficits, less need for such high interest rates in the domestic economy. So Brazil moving to an overweight stance here, but keeping Taiwan and South Korea as underweights, really around this recognition of an inventory pull forward, Section 232 tariffs, and wanting to see that clarity before we reassess on Taiwan and South Korea. So just quickly on Japan, as my colleague Laura will take us through her views on China. So Sho Nakazawa in Tokyo, they've just concluded the Japan summit there. For us, we've moved the targets higher from 2,600 to 2,900 as we look out another 6 months. The earnings story is one of really factoring in that rebasing of the FX. Dollar yen going to 130 by the middle of next year, 124 by the end of next year. And so as corporates get more realistic and the exporters acknowledge that challenge, we think earnings will miss on the downside, but valuations can move a little bit higher from here as we start to look into the recovery. But most importantly, seeing very consistent trends of domestic reflation in Japan continuing to support the ultimately the top line growth, the revenue growth, and the earnings growth in Japan, which has been giving a quiet and a kind of steady bull market of 9% EPS growth in the last 10 years. And we think that that underlying trend of improving profitability can continue to come through both from the nominal exposure to a reflating economy from strong wage trends, but also the corporate reform. And our colleague colleague Nakazawa-san has done a lot to map out individual beneficiaries of themes like the unwinding of cross-shareholdings, unwinding of parent-child transactions, and ultimately MBOs also continuing to come through at a pretty steady clip. So do pull up the research on looking for beneficiaries within Japan, but ultimately that is playing out at a macro side. Sectors and themes, just quickly, not a lot of change here from our previous starts, which is to continue to recommend being overweight financials versus underweight on semis and IT, semis and hardware in particular. So within this, we think financials are key adopters of AI, but they're also going to be benefiting from just good total shareholder return yield support. And we'd like this in favoured markets like Singapore, Brazil, India, and the UAE. So within this, we think they can continue to outperform. And then outside of these, we like industrials and select supply chain diversification beneficiaries, as well as AI adoption leaders, which my colleague Laura will no doubt talk about within China. So within the focus lists, just two changes for us on the regional side, adding to that theme of product profitability leaders and industrials, supply chain diversification beneficiaries. We've added Shenzhen Innovants and BYD to our APXJ and GEM focus lists. So with that, covered a lot of ground. I'll pass back to you, Crystal.
Thank you, Daniel. In the region, China remains a key market focus. So let me invite Laura here to share how to play China equities.
Thanks very much, Crystal. Very happy to be here to be on this timely session to share our mid-year outlook, latest view regarding China equity market. I guess the bottom line is that we think China market setup, the dynamics remains quite solid. We turned a lot more constructive on China equity market since February this year. We believe there's a number of structural improvement that's been ongoing since second half last year. And so far, we don't see any major hurdles that could really hinder or set back the structural improvements. And therefore, we remain relatively constructive on China. Just let me quickly share my screen here so I can show some charts to illustrate the points. And please let me know if you cannot see it. So the first chart I actually want to show is this long-term ROE trend for MSCI China, and MSCI China being the most followed after global index for China's purpose by institutional investors. You can see that, as I was pointing out, China's ROE had effectively bottomed out since second half of 2024, and it's been very consistently going up since then. And we actually believe this trend will continue, and eventually, before the end of 2026, there is a very good chance for MSCI China to actually catch up and then eventually surpass MSCI EM from a ROE perspective. So what's been driving this ROE improvement, and why do we think it's sustainable, even though the macro condition remains somewhat challenging, as Zhipeng pointed out earlier? So basically, we think it has a lot to do with the self-help effort from the Chinese corporates from a bottom-up perspective. What we saw is that a lot of high-quality large-cap companies, particularly in the internet sector and in the financial sectors, and in the internet sector, you know, it's largely broken down to consumer discretionary, which represents the e-commerce segment, and then the communication services, which is largely the media and entertainment portion of the internet space. So these companies actually have been doing very aggressive cost cutting, and they have been engaged in more share buybacks and dividend payouts, as we know. And also another sector we want to highlight is the information technology sector. Actually, these companies, as the new generation of tech leaders, not just within China's space, but more so on a global basis, particularly since January this year, they are starting to also show quite resilient and a satisfying result from an earnings delivery and ROE delivery perspective. So the chart on the screen you see right now actually shows you how much collectively these four sectors have been gaining more and more index weight within the China equity space. At the same time, as much as we worry about the macro situation and the persistent deflation, we need to acknowledge that the sectors that are more correlated with the macro condition, with tightening of some of the regulatory policy, as well as with the deflation situation in general, they are representing smaller and smaller index weights. And those are namely, for example, consumer staples, heavy industrials, property, and materials. So as a result, if you look at the average ROE of these two groups of companies, you actually can see the big difference between the two crowds. And this actually makes it very clear why the ROE trend has been effectively going up despite the top-down macro challenges. And this is also why we think that the trend is sustainable as these companies continue, the high-quality companies continue to take up more shares in the overall equity space. And then I think the bottom line is that for the rest of 2025, and then for most, if not all of 2026, the macro condition will continue to be somewhat challenging with deflation still ongoing. But then eventually, as we go into 2027, that's very likely to be the first year that China really comes out of deflation and with a broad level macro condition improvement and potentially a much broader level sort of earnings growth turnaround story. So that could be for someone who's more look at China from a macro perspective, and that would be the timing you want to focus on. And then so that's structural improvement number one. And number two, we actually want to highlight the most recent sort of more I would say satisfying and within expectation kind of earnings results delivery. I would say ever since second half of 2021, as you can see from the screen, China has been going through a very, very brutal and a very extended period of downward earnings revision cycle. For 14 quarters in a row, you saw that for every single quarter, China, be it MSCI China, the bigger index, or the Asia market itself, they've been disappointing investors every single quarter, not just by a small margin, actually by a significant magnitude. Basically, every single quarter, somewhere between 20 to 30%, and sometimes close to 40% of the index companies would actually miss the earnings estimates expectation. The good news is that since the fourth quarter last year, that had finally started to change. So fourth quarter 2024, MSCI China for the very first time delivered a inline results. And the Asia market actually still lagged behind quite significantly. That was because, as I was trying to explain earlier, those high quality large cap companies are actually more concentrated in the offshore space, particularly the internet companies, than for the Asia market. And we will share with you another chart later during my presentation to illustrate that point. But then fast forward to first quarter 2025. Finally, Asia market also caught up, and we see the very first time that both the offshore market and the onshore market delivering a inline result. So I think this is a very important inflection point that we want to attract investors' attention to. This means finally, after a 3.5 year period of downward revision, the starting point of China equity space earnings expectation or potential earnings growth outlook has finally been reset to a lower base and a much more realistic level. So going forward, I think it is more, I would say, reasonable and easier for these companies to potentially deliver continuously in line or even better than expected kind of results. And that earnings revision momentum and the trajectory compared to some of these other countries or markets with much higher expectation from investors and potentially as a result, a harsher kind of a downward revision path in the coming months or quarters. I think China's setup would be considered as much better in that sense. And then very quickly, just I would say a revisit to our China equity assessment framework. So we have 7 factors that we think overall would be quite influential in terms of driving the directional changes of China equity market. And usually if we see 4 or more factors net going in one direction, we would consider a rating change. And that's what happened back in February as we upgraded China. And then as of now, we see 3 absolute improvements along these 7 factors. So not enough to drive a upgrade, but enough for us to expect a higher price target. So I just talked about how the earnings estimates have become more realistic, setting a much lower base to start with. So from a relative negative to become a neutral factor, we consider that as an improvement. And then Zhipeng also talked about how FX would stabilize for the rest of the year, and actually with also marginal strengthening through the course over the next 12 months and even longer. And then U.S.-China confrontation with the joint agreement on the trade negotiation, I think with everything else being equal, it's fair to say that things have calmed down somewhat. So we consider that as an improvement. Of course, it's a very fluid situation, and we will continue to monitor it very, very closely. So as a result, if I may just show you our new expectation of earnings growth for MSCI China quickly, 7% earnings growth for this year, 6% next year, and then, as I mentioned, with macro condition improving in 2027, we are expecting a higher earnings growth at 9% in 2027. And then for valuation, we see a somewhat flat valuation path for MSCI China. This is very well within our sort of valuation range between 10 to 12 times that we think is the new valuation regime base case for China. And we continue to believe that China will be valued at a mild or a moderate discount versus the broad emerging market because of the trade tension uncertainty and because of the macro slowdown concern. So we think that our forecasts at this point are rather sort of reasonable and even more probably skewed to the conservative side. So we are very confident of the potential sort of realization of our base case scenario, which for MSCI China would be 78 in 12 months. For CSI 300 would be 4,000 in 12 months. I think very quickly I want to touch upon the AH preference because a lot of investors actually are very interested in this potential trade. We actually turned more sort of I would say turned more constructive on Asia market versus the Hong Kong market right after the 2nd of April, after the Liberation Day on tariff. But then at the early signs of sort of trade negotiation potentially kicking off, we advise investors to switch back to offshore over Asia market because usually Asia market tends to be less sensitive to geopolitical concerns and currency depreciation. So when that trend starts to reverse, we would advise investors to switch to the offshore market. And I think that preference for the offshore market still holds, and we still recommend you to overweight more offshore versus Asia in your overall China portfolio. And as I was making this point earlier, we also believe that the macro/deflation correlated sectors actually represent a much bigger portion of the Asia market, as you can tell here, close to 30% of index in CSI 300 versus just 12% in MSCI China. So that's another reason to actually believe that the offshore market should have a better performance in the next 12 months versus the Asia market. And then the key trades, we continue to believe that number one, trade actually own more offshore versus onshore, as you can tell here. And then our Hong Kong China focus list and Asia thematic list. Our Hong Kong China focus list is a relatively balanced approach. We are very positive about the large cap internet companies who have leading edge, particularly in AI adoption and development space. And we also want to hold on to a few names directly in the technology space that start to appear as the new generation of champions on a global basis. But at the same time, we do maintain exposure to certain utilities and the dividend play companies just because we want to keep access to that stable cash return to help smooth out some of the volatilities. And then the third trade actually we want to single out the AI technology and smart manufacturing space as the new structural investment opportunities in China, because we think that for very, very long time, investors have actually struggled with finding a group of Chinese companies that they feel comfortable holding on to on a longer term basis. And the China equity space actually has gone through multiple generations of these champions since 2000, starting with the late 1990s, like the telecoms, and then energy companies, financial companies, conventional consumers, and then most recently the large cap internet companies. But because of COVID, because of multiple world framework, I think a lot of concerns have emerged about deflation, about consumption demand coming down at a slower pace, growing at a slower pace, etc., etc. So that anchor point to put your money on a long-term basis in China, I think that narrative was gone for some time. So I think again, since January this year, investors' confidence has been being rebuilt. I would say, believing that China would be able to stay in the game, in the global tech competition, and not just being able to sort of stay in the game, but also be able to potentially lead the global competition with these new generations of champions emerging and eventually excelling on a global basis. So we have a few themes under that overarching theme, and we have stocks names available for your consideration. This is it for our mid-year outlook, and back to you, Crystal. Thank you.
Thank you so much, Laura. Now we're shifting focus to Japan. I will pass it now to Sugisaki-san for his views on dollar yen and also JGB views.
Yes, sure. Thank you very much for the introduction. Let me start with the JGB outlooks. On the rate space, we expect the JGB to grade lower throughout the forecast horizon as the market price out the future BOJ's hikes. Our economists teams expect the BOJ stay on hold up to end of the 2026, as they think the BOJ needs extra time to assess the potential impact of the U.S. tariff on the corporate earnings and the subsequent wage negotiation next year. They also see the prospected global economic slowdown later this year can also make it difficult for the BOJ to continue the policy normalization. Under such situations, we expect the short to the medium-term rate expectation to be repriced lower as the market loses hope for the future BOJ's rate hiking cycle. We see the term premium up to the 10-year sector will likely be pushed lower as we see the banking community eventually come back to the JGBs once they lose the hope for any BOJ rate hiking cycle in the future. On the other hand, the long and JGB situation a bit tricky. We see the term premium on the 10-year plus sector facing the further cheapening pressure due to the structural weak supply-demand profile. Without the domestic structural buyers' demand, such as the lifers and pension funds, the mark-to-market sensitive investors, such as like dealers and overseas investors, absorb the still elevated monthly supply. And this basically requires a more term premium in the long end. So we expect the long end JGB to face a further steepening pressure, at least in the near term. We expect the 10-year plus curve to bull steepen towards the fourth quarter 2025 until the market fully prices out the near-term BOJ rate hikes. We expect the value of the curve to outperform the most towards the fourth quarter 2025, given it's the drag to carry and roll down, as we see the volatility in less than the 10-year sector gradually to come down with rate expectation anchored. We expect the 10-year JGBA to reach the 1.15% in fourth quarter 2025 and 0.9% in the second quarter 2026. Let me move on the FX side. As our colleagues already mentioned, to some extent, we broadly see the dollar weakness trend to continue, given the backdrop of the sharp growth slowdown in US relative to the rest of the world. We see the dollar weakness particularly seen from the fourth quarter 25 to the second quarter 26, as we see the US hard data start to show the clear weakness in response to the higher tariff effect during this period. On top of that, we see the market continue to price in the negative premium in dollar, given the US political uncertainty likely leads the investors shifting away from the US assets. We expect the DXY to go decline to the 91 in the following 12 months. On the other hand, we expect the yen to become one of the outperformers, as well as the euro and Swiss franc. Given the skepticism among the US safe haven status, we see these currencies to be benefited as an alternative of the safe haven dollars. Indeed, the recent most international transaction in securities data, which it suggested that the overseas investors has increased the Japan asset exposures since the reciprocal tariff announcement in both the equity and fixed income space. The part of them might be FX hedged, taking advantage of the still attractive yield pickup. But the outright effect to buy yen which will lead to the recent yen strength to some extent. On top of that, we think the prospect for the policy convergence between the US and Japan also continue to lower the dollar yen as well, and we expect it to go lower to the 126 by the second quarter 2026. I'll stop there and pass over to the Jack.
Thank you so much, Sugisaki-san. And then last but not least, let me invite Gek here to talk broadly on EMFX and rates.
Yeah, sure. Thanks, Crystal. So yeah, for the Asia FX outlook, the dollar direction is quite crucial because what we've seen since the start of the year is that the dollar weakness has helped to sort of trigger inflows into the EM local currency funds. So as Koichi sort of mentioned earlier, we do expect the dollar to continue to weaken on the back of US growth and rates converging to the rest of the world. So given this backdrop, we do think that Asia currencies will benefit and appreciate, especially because Asia investors will be a key part of the dollar hedging story, with many economies in this region running current account surpluses and being holders of the dollar assets. And we also expect Asia currencies to benefit from exporters increasing their FX conversion because Asia exporters have accumulated dollars over the past 2 to 3 years. So they could have more incentive to convert them into local currency now with the dollar weakening and the experience of the sharp rally that we saw in Taiwan dollar earlier this month. And also right now, one of the key focus for a lot of FX investors as well is that currency could be part of the trade negotiations with the US. We've seen places like Taiwan and also Korean won getting some boost from that angle, but on the back of market expectations. So we're in this phase of the trade negotiations. So we do think that the market expectations of currency appreciation potentially being brought up in the negotiations with the US could also help to provide some support for Asia FX as well, even though we're not sure that the final deal will really have an aspect of that, of currency appreciation there. So yeah, overall, we think that the backdrop is quite positive for Asia currencies, but we do think the gains will be more modest than against the than what we're seeing in the G10 currencies. So on average, we have Asia FX appreciating by about 2% by year end, compared to around 5% in the DXY dollar index, which is dollar against G10. So that's ultimately because global growth is still weakening, particularly in the trade side, and that's not good for Asia being very trade exposed region or also Asia's current account dynamics as well might sort of see some negative impact from that. And we do have, say semiconductor tariffs that could also come around the middle of the year. And there's also the risk of renewed escalation in terms of trade tensions, and also from a carry perspective, it's also more favorable to hold dollars against Asia currencies, at least until US yields start to decline more meaningfully from the fourth quarter onwards in our forecasts. So that's why we think gains in Asia currencies might be a bit more modest and a bit more backloaded, with the appreciation being stronger from fourth quarter onwards. And in terms of the relative preferences within Asia, we think it'll be the current account surplus currencies that are outperforming, because these are the holders of dollar assets and they will benefit the most from the hedging or the exporters' FX conversion dynamic. So CNH might be an exception here, as Chippo mentioned earlier, but we do think other than outside of CNH, we have the current account surplus currencies like Thai baht, Sing dollar, and also Taiwan dollar outperforming, because they come out top if we consider things like correlation with Dixie, the size of their current account surpluses, the size of the dollar asset holdings, as well as who have already seen capital outflows. So there might be a bit less pressure from that front if we get another bout of risk off as US hard data weakens. And Thai baht also gets the additional support from the correlation with gold prices, and which could benefit from the continued search for a new safe haven outside of the dollar. And Taiwan dollar could benefit as well from the local investors' FX hedging. So that's why we think these three currencies might outperform. And on the flip side, we think IDR and Philippines peso might underperform because of the current account deficits, which might become harder to fund if we get risk appetite weakening with slowing global growth. And these two places also see a bit more dovish central bank policy, which could weigh on the currency. And then on the rate side, we think Asia yields will fall broadly because local growth and inflation are slowing, and the strength in the Asia currencies do provide room for the central banks to cut rates, as Derek mentioned earlier. And as US yields fall more meaningfully from the fourth quarter onwards, as investors start to price in the aggressive Fed rate cuts next year that we have penciled in our forecast profile, that would also help Asia yields to fall. And we like India rates the most because of the RBI's liquidity support measures, including rate cuts and open market operation bond purchases, and also this continued path of fiscal consolidation. And if we look at the current market pricing for RBI rate cuts, it also doesn't look particularly stretched, with around just 2 rate cuts priced. So we think that's still a good place to be long as well. So yeah, maybe I'll leave it there and hand it back to you, Crystal.
Thank you so much, Gag. Now we'll move across to the Q&A session. And because of the time limit, we'll only take one question today. So this is for Lisa and Sugisaki-san. How do you see the bear case and financial stability risk of continued falls in long-dated JGBs?
So let me start from the global side. We never ruled out the recession scenario in the United States, but for that to happen, we are expecting that we need to have the U.S. administration returns to the reciprocal tariffs of 23% of effective tariff rate. And also we need to have need to assume that the budget process leads to the federal spending cuts. In that case, we will have a recession in the United States, which will mean that the negative impact for the foreign demand for Japanese economy. And more generally, because of the spending increase in United States as well as the countries like Germany, there are several concerns. In addition to the lower growth rate, that situation is actually not getting better. So generally put, the slower growth will mean that the higher debt going forward. Yeah, that's it from my side.
Yes, for the to be honest, our bear case of the JGB is more like the BOJ continue to hike the rates. So if the US and Japan reach some agreement within the US-Japan trade negotiation within 90 days, it might become it might open the door for the BOJ start to hike the rate once again. In such a case, the belly of the curve red sell-off, and we basically see the bear flattening of the curve. But I agree that the people really care about the potential for selling dynamics, particularly in the long run. This is true. because if the Japanese current accounting basically forced to the investors to realize the loss if the market valuation of the corresponding bonds decrease more than 5%, more than 50% of the face values. And some of the long and JGB yields bonds are already traded close to the 50 yen, which means that some of the lifers who hold the corresponding bonds now faces the risk to realize their loss from the accounting perspective. So if the yield gonna higher and higher, lifers increasingly becomes the seller rather than the buyer of the long end, which actually becomes a risk of the long end yield to gonna higher further. But from the financial stability viewpoint, I think the BOJ seems to be not care about much about the long end yield, because the BOJ already mentioned that the less than 10-year yields should be the important from the economic perspective. You know, the most than 70% of the household borrowing are linked with the floating rates, and the corporate capex investment and the subsequent lending from the bank are basically 5 years. So the less than 5 years should be the very important from the economic perspective, and less important in the long end. So if the long end sell-off actually led to the sell-off in the short end as well, via the repricing of the term premium rather than the rate hike expectation, this actually becomes a matter for the BOJ, and the BOJ might conduct some measures, but we are not still in the case. We are not still in such case.
Oh, and sorry, we had one more. Sorry, I talked about the U.S. The econ downside scenario, but let me talk about the upside scenario where if the policy uncertainty, which cannot be eliminated, but markets come to believe that the current tariffs may represent a ceiling, not a floor, and that's one thing. And the legal immigration, if they are allowed more, they will be also positive as well. So in those cases, we can see some upside in terms of the U.S. economy. That will add, of course, to the upside scenarios for countries, including Japan. Thank you.
Great. Thank you so much, both Lisa and Sugisaki-san. And in the interest of time, we'll conclude today's webcast here and answer remaining questions offline. If you find this session useful, you may want to join our other series or go to the Asia Research landing page on the portal for a collection of the region's most important research and our audio video series. Thank you for joining, and do reach out to me and the team if you have any other questions. Have a nice day.